Discover the tips and strategies that will help you achieve your retirement goals. I'm your host, James Knoll, and this is the podcast dedicated to helping you retire well. It all starts right here on Ready for Retirement. Hi, everyone, and welcome back to another episode of Ready for Retirement. I'm your host, James Knoll, and we have a listener question today that touches upon withdrawal rules and really how do you invest in a way to take advantage of the withdrawal rules and the literature and the research that's been done around that. So let's look at the question. The question is this. It says, "Hi, James, very much enjoy the podcast and have become a regular listener. I have even gone back and listened to podcasts you have previously recorded. Thank you for your efforts. You refer to the 4% rule and the need for a portfolio allocation to support that approach. Can you provide your listeners more detail on what the portfolio allocation looks like to support that 4% rule?" This question is from Michael, and Michael, thank you very much for that question. And yes, we'll be happy to. So on today's episode, what we'll do is we'll walk through just a quick summary of what those rules are, whether it's the 4% rule by Bill Bengen or whether it's Guyton's Guardrails. But more importantly, how do you invest in a way, or how does their research suggest that you invest in order to be able to take out those withdrawals? Now, real quick, before we jump into today's episode, I wanted to highlight a recent review on the podcast. This comes from Nath123XYZ, WR134 username. And the title is a very helpful podcast. And Nath says, "This is one of the best retirement podcasts I have listened to. James gives great information and he breaks it down in simple terms. He even responds to listeners' questions. If you're looking for retirement information, you should check this podcast out." Thank you very much for that review, Nath. Really appreciate that. Really appreciate all of you who have left reviews. And if you wouldn't mind doing so, it helps the podcast out a bunch. If you can just go in and tap 5 stars in iTunes, and if you'd like to leave a review, a written review on top of that, that also is very helpful as people are looking for good information to consume, want to be sure that this podcast is in front of them. So thank you for that review. Now let's jump back to this question. So I want you to keep this in mind before we go much further. The 4% rule. Guyton's Guardrails. These are great pieces of research. And what they've done is they've taken all just historical data, going back a certain number of years and decades even. And what they've tried to solve for is what is the highest sustainable withdrawal rate that one could safely, and by safely I mean without too much of a risk of running out of money, begin to draw from their portfolio. And it looked at taking these withdrawals using different investment types. So one thing to look at is this is not unique to any particular individual. This is not strong recommendations for one person's specific situation. This is just general research done looking at general asset classes and general withdrawal rates. Ideally, you would customize this to yourself, but let's take a look at this. With the 4% rule, made famous by Bill Bengen, this was kind of the seminal research at the time of understanding how much can we look to take out of our portfolio without running out of money. Now, the analysis was very simple when looking at how that portfolio that the research was based upon was invested. It was literally just 50% of the portfolio in large cap stocks. So look at the S&P 500 as a benchmark for something like that. And then 50% in intermediate term US Treasury bonds. So no small companies, no international, no real estate, not any types of tilts anywhere, not any alternative asset classes. It was just a very simple, straightforward, but half the portfolio in large cap stocks and half the portfolio in intermediate term US Treasury bonds. Now, nothing necessarily wrong with that. You need to start with something when you're doing a research paper. But Bill Bengen's actually since revised this research a little bit, and he actually added small caps or small company investments to the portfolio as well. So he's now looking at 30% large companies, 20% small companies, 50% intermediate term treasury bonds. And what he saw was you could probably increase the withdrawal rate up to about 4.5% if you diversify more than the original research. So what do you do with that information? Do you literally go and put half your portfolio in big companies and half of it in bonds, or 30% in big companies, 20% in small companies, and 50% in bonds? You could, but again, keep in mind this is just a starting point. Not every single person who has a portfolio going into retirement should necessarily be invested this exact way. Ideally, you want to use this as a starting point and then consider some key considerations I'll lay out at the end of this that will help to maybe tweak some of this or customize some of this for your individual specific situation. Now, those allocations are for the 4% rule. That's Bill Bengen's original research of how do you create a sustainable withdrawal rate over time. I have mentioned on previous podcasts that what I'm more of a fan of isn't the 4% rule or even the 4.5% rule, but something that's called Guyton's guardrails. So John Guyton, another researcher, also financial planning practitioner, did additional research where he said, wait a minute, with the 4% rule, you essentially take a starting value of your portfolio, take 4% out, and then adjust that number higher each year for inflation. What you're not doing, though, is you're not making adjustments if the market's up or if it's down or if different things are happening. It's not really telling you where to pull money from. It's just you take 4% and you go. He said, is there a better way? What if we implement some rules around our withdrawals? And he called those rules guardrails of how do we give ourselves raises over time? If the market's doing really well, do we just keep taking that 4%? Or could we maybe enhance our retirement and income? What about when the market's down? We all know that the worst time to sell good stock investments or great companies is when they're down. So shouldn't that somehow impact our withdrawal strategy and how much we take out? And John Guyton said, yes, it absolutely should. So he said, how do we design a safe withdrawal rate that can last for 40 years potentially into retirement, but you must make some dynamic changes along the way? So at the end of the day, what it does is it allows you to take more out of your portfolio on a sustainable basis than the 4% rule does, but there's some work you need to do to maintain that because it is a much more dynamic approach. And what he saw was, depending on your age, you maybe can take 5.2 to 5.6% out of the starting value of your portfolio if you follow some key rules along the way. I'm not going to go into all these rules today because we did a full episode on that. And if you want to listen to that episode, I recommend you check out episode number 27, just titled, How Much Can I Safely Spend in Retirement? And we talk about these 4 rules. 1 is the portfolio management rule. 2 is the withdrawal rule. 3 is the capital preservation rule. 4 is a prosperity rule. Essentially saying, once you have a starting portfolio value, what are the changes and tweaks you need to make along the way to ensure that this portfolio can continue generating income throughout your retirement? Now, with Guyton's rules, he didn't just look at the same 50% in large cap stocks and 50% in bonds that Bill Bengen did in his original research. He actually looked at 3 different portfolios. He looked at one portfolio that had 50% stocks in it, just like the Bill Bengen research, the 4% rule did, 50% stocks and the remainder in bonds or cash. He then looked at a portfolio that had 65% stocks in it, and he looked at a portfolio that had 80% stocks in it. Now, all of these different allocations to stocks or bonds or cash, there is different pros and cons. Some maximized the likelihood of this portfolio lasting as long as possible. Some maximized the chances of you being able to spend more throughout retirement or have more left over at the end of your retirement. But let's look at the 65% allocation, the one that's just right in the middle, just to kind of use that to see what were the asset classes that he suggested there. Well, in the research, if you have 65% or the 65% portfolio, that was broken down as follows. 10% of the portfolio would be in cash, 25% of the portfolio in bonds, 13% of the portfolio in large cap value investments, with 13% of the portfolio in large cap growth investments, 9% of the portfolio in US small cap value stocks, 9% of the portfolio in US small cap growth stocks, 15% of the portfolio in international stocks, and then 6% of the portfolio in real estate. So as you can see, it's a lot more diversified than the research that Bill Bengen started prior to this, where it was just 50% S&P 500 stocks, 50% intermediate US Treasury bonds. He went through this and diversified it more. And just logically thinking, if you just play this out, it would make sense that a more diversified portfolio could probably sustain a higher withdrawal rate, simply because you have more options to choose from of where you're going to pull money from. And now this is in alignment with one of the rules of the Guyton guardrail approach, which is you don't just pro rata take money from a little bit of money from each of these different investments you have each year. There's rules that you follow of where do you take money from based upon what's up or down. And it's those rules that drive the ability for this to create higher income for a retiree while still sustaining that longevity of the Now, if you have the 50% stock portfolio or the 80% stock portfolio in the Guyton's Guardrails approach, those allocations, of course, are going to be different because they have different amount in stocks versus bonds. I'll actually include a link to this paper that was done that actually outlines in a chart here how to invest in each of these. But I do want to be clear. The big thing isn't so much how do you start with the investments, although that's big. Some people say, okay, great. I've got my allocation down. I've spread out my portfolio that way. Now I'm good to go. I'm just going to start taking 5.5% or whatever it is from my portfolio and call it a day. That is a very dangerous approach with this because if you're not making those dynamic changes along the way, I do want to emphasize this approach is just not going to be relevant. It's not about how are you invested. That is part of it, but the remaining part is what changes do you make along the way. So those are the allocations. Going back to the listener question of, can you talk more about how do we invest in order to take advantage of some of these rules? That's what it looks like. Now, what I do want to talk about now is what this doesn't take into account. What this doesn't take into account is sometimes what's reality, what's more common. For most people, it's not as if they start retirement and turn on the income and that income stays the exact same for the rest of their life. People have other goals. Life isn't so linear as to think that this same exact amount is going to meet your needs every year. You might have other spending goals. Do you want to buy a boat? Do you want to buy a home? Do you want to send grandkids to college? Sometimes there's these one-off things that are going to cause you to have to spend more in some years. So if you are taking all the way up to the maximum amount of your portfolio based upon some of these rules or based upon some of this research, and that's providing you your monthly base income, and you say, great, I'm happy on this income. But then you're also, maybe once a year, writing a check to help grandkids go to college or to fund their 529 plan. Or once every few years, also buying a car in cash on top of all this. Or you go and buy your dream vacation home on top of this. The sustainable withdrawal rate just will not work in that case. It's designed to show you a ceiling on how much you can spend. And if you are spending all the way up to that ceiling and also buying some one-off things, then that's just not going to work out over time. What you would have to do is almost look at those one-off purchases, the boat, the home, the college, the whatever it is, and find a way as much as possible to include that in the monthly amount that you can take out, at least from a planning standpoint. So maybe you take a little less each month knowing that once a year, you're going to have a big lump sum payment for trips or boats or homes or whatever it might be. So keep that in mind. This does not count for other spending goals, or it does account for other spending goals. I shouldn't say it that way, but the way our minds look at something is we look at, okay, what's the monthly amount that can be generated? And then we don't factor in the other things that also need to come from our portfolio above and beyond that. Another thing these don't take into account is really legacy goals. Now, these papers, this research was designed to say, how can you maximize income or at least take a sustainable withdrawal rate from your portfolio? If legacy is important to you, of wanting to leave money to family or charity or somewhere, and you want some lump sum set aside to leave or some goal to leave, that isn't really going to explicitly be included or factored into this research. So that's where you have to massage this a little bit and understand what portion of your portfolio needs to be set aside for legacy goals, what portion of the portfolio can we actually use to generate some of these withdrawal rates that we want to do. Taxes. Taxes are not explicitly accounted for in these scenarios. Now, it's not that the rules don't take into account taxes. Again, it goes back to the average person's way of looking at this, doesn't take taxes into account. So, for example, let's assume that you have a portfolio of $1 million, and based upon how you're invested and your portfolio and age and all those different things, you've decided that a 4.8% withdrawal rate is the right number for you. Well, most of us, we do that math and say, okay, we have $1 million, and if we multiply $1 million by 4.8%, that gives us $48,000 per year. If I divide that by 12, that's a $4,000 per month income. Great. I have $4,000 per month of income to go spend. Well, not really, because that $4,000 is pre-tax. So that's $4,000. That's the most that the portfolio can sustainably generate. The research doesn't know whether this money's in a traditional IRA or a Roth IRA or a brokerage account or where it is. So make sure you're taking into account taxes on top of this, because if you want a net distribution of $4,000 per month, so net meaning after taxes, if you want $4,000 per month and all this money's in a 401k or IRA, well, $1 million probably isn't going to cut it, because once taxes are taken out, you're either going to have less than $4,000 per month, which isn't enough for you, Or you're going to be taking out too high of an amount from your portfolio. You might actually have to start taking $5,000 per month to give you $4,000 per month after taxes. And if you're taking $5,000 per month, that's $60,000 per year, which on that $1 million portfolio, you're now looking at a 6% withdrawal rate. So it's not that this research and these rules don't take into account taxes, but oftentimes when people look at this and our perception of it, we forget to factor in taxes. So make sure you are including that when you're factoring in and when you're calculating how much of a portfolio you need. Another thing that this doesn't factor in is this is purely looking at retirement income. For some people, when they've done a great job of saving and investing, retirement income isn't going to be too much of an issue. They may have more than enough to cover their income needs and then some. Well, what happens if you need $40,000 per year from your portfolio? And I know we just talked about taxes, but let's, for a second, just to simplify this, let's take taxes out of the equation. So disregard taxes for a second. You want $40,000 from your portfolio, and you have $2 million in your portfolio when you go to retire. Well, if you're following the 4% rule, just to keep this super simple, you only quote unquote need $1 million to be able to create that $40,000 per year of income. That $1 million multiplied by 4%, that's $40,000 per year. Well, what about with the other million that you have? So keep in mind, you have $2 million at this point. Do you invest it all the same and just take 2% out per year because 2% of $2 million is that $40,000? Well, you could do that, but keep in mind these allocations that we're talking about, whether for the 4% rule or Guyton's guardrails, these allocations are designed to show you how you need to invest if you're trying to maximize the sustainable withdrawal rate, the sustainable income from your portfolio. Sometimes it's helpful to almost bifurcate your portfolio. Look at what portion of my portfolio is needed to create the sustainable level of income and invest that one way. Well, with the other portfolio or the other portion of it, so in this example, the other million, what do you want that to do? And this is really going to be dependent upon you. Do you want this to be invested more aggressively because you want it to grow for legacy, or you just want it to grow because you've worked hard for your money and you want it to work hard for you? Do you want this money to be invested far more conservatively because you just really don't like the ups and downs of the market and you just want to have it there growing still, but maybe not quite as much volatility or uncertainty as the market? That's what this isn't going to really account for. This is how do you invest your portfolio to create maximum sustainable income, but that might not be, that certainly isn't the only goal for a lot of retirees. And then lastly, and again, not that these are all the things that this doesn't take into account, but some of the bigger ones that I see, but lastly, this doesn't take into account necessarily your age. Should someone who's retiring at age 70 be invested the same way as someone who retires at age 50 in order to create a sustainable withdrawal rate? Not necessarily. These rules were written, or the research was done with the understanding that somewhere between 30 to 40 years is how long these portfolios were designed to create income for. So if you are retiring, say you had an amazing career and you loved what you did so much that you worked until 75, and you have good health and maybe a life expectancy of say 90. Well, your portfolio only needs to last for 15 years in that example, assuming that your goal is just to maximize income. Well, should that individual take the same amount of income from someone who retires at 50 from their portfolio? Absolutely not. The later you retire, the more you can afford to take out from your portfolio because you don't need it to last as long. You can afford to take more out than can the person who retires at 50 and maybe has 40 to 50 years of income needed from their portfolio ahead of them. So love this question. It is good to see how should our portfolio be invested to follow the 4% rule or to follow the Guyton guardrails approach. But I do want to emphasize, these are just starting points. Use this information of the 4% rule or the Guyton guardrails approach of how did they allocate portfolios in their research to back test the research done to understand how much we can safely take out. Start there, but then make sure that your allocation is unique to you. What other considerations do we need to take into account? What are the other spending goals you have? What are your legacy goals? What's your tax situation going to look like? What if you have more than enough to create the income you need? How do you invest the rest? What if you retire earlier? What if you retire later? These are all the types of things you want to consider above and beyond just making sure that your investments are allocated the right way. So great question. Thank you for your question. Again, if you're listening and have a question, you too can submit that and I'll answer it on a future episode. To do that, just go to the readyforretirement.co webpage and click on submit your question, and that will come right through to me and I will queue it up for a future episode. So again, thank you for listening. If you've not already done so already, please check us out on YouTube. The YouTube channel is under the company page, Root Financial Partners. Lots of great content there on top of the content we have here. Always appreciate you listening, and I'll see you next time. Thank you for listening to another episode of the Ready for Retirement podcast. If you're enjoying the show, please subscribe and let me know by leaving a 5-star review. And as always, for a list of the notes and the resources mentioned in today's episode, you can find those at the Ready for Retirement website, which is readyforretirement.co. That's readyforretirement.co. And if you have a question that you would like for me to answer in a future episode, then you can also go to the Ready for Retirement website, readyforretirement.co. There's a page called Submit Your Question where you can submit a question for me to answer in a future episode. Thanks as always for listening, and I'll see you next time. Hey everyone, it's me again for the disclaimer. Please be smart about this. Before doing anything, please be sure to consult with your tax planner or financial planner. Nothing in this podcast should be construed as investment, tax, legal, or other financial advice. It is for information